Welcome back to the weekly news recap. Today it might sound a little different because I'm still kind of sick, but let's get started. This week we had the Mick incident. McDonald's CEO managed to basically break the internet by supposedly eating his lunch. To promote the new Big Arc burger, which is McDonald's latest burger they just released, the CEO hopped on Instagram to show the world how good this burger is. But instead, the internet was just laughing and feeling weird about how unnatural he looked basically eating the burger. The CEO, Chris, was standing there with a big arch burger and he called it the product. Not a burger, not a meal, just the product. Then he said he went in for the attack. He looks at the burger with like confusion in his eyes, like he had never seen it before. And he says, I don't even know how to attack it. And when he finally takes a bite, it's really just a little nibble. And he looks at the camera with a straight face and says, that's a big bite for a big arch. And of course, the rest of the food world basically wanted to get in on this media. Burger King's president posted his own video with also no script, where he unwrapped a Whopper and took a bite so big that he needed to wipe his face off with a napkin. And the caption was, thought we reply to this. Then Wendy's also chimed in on social media saying, there's a lot to unpack here. Even Wingstop got on this saying, is the big bite in the room with us right now? Even Mini Cooper, the car company, joking that they would start testing their cars 1 meter at a time to match the CEO's energy. So what was the aftermath of all this? Well, we know the CEO doesn't eat this for lunch. The CEO tried to be relatable, but basically seemed terrified of his own brand's offering. And it created this uncanny valley effect. But ironically, Apex Marketing says this fail actually generated about $18.4 million in free publicity for McDonald's because people were obsessed about how weird the video was. Moving on to our next story, it deals with the ripple in the Middle East. And we start with the luxury sector, which had a brutal week. If you've been watching LVMH, Kering, and Richmond, you've seen just basically dumps of their stocks because the Middle East is a significant golden triangle of Dubai, Abu Dhabi, and Doha had a significant shift in their luxury growth due to the active conflict. Following the escalation between the US, Israel, and Iran, over the past week, flagship stores like Dubai Mall and the Mall of Emirates have literally shut down. And it's not just about the stores closing down, it's about the Ramadan rush. We're right in the middle of the peak shopping season where affluent Gulf travelers usually head to Paris, London, or Mali, or Milan to spend millions of dollars. With airspace over the Emirates closed and flights grounded, that revenue isn't just delayed by a couple months, it might just be disappearing completely. Richmond, which owns Cartier, saw its stock plunge nearly 6% because 10% of their global revenue is tied to this region that's in conflict right now. And this sector was already struggling with the slowdown in China. This Middle East breakout is the last thing they wanted to see. However, while these high-end stores were hurting, there was an absolute winner for these markets right now, and that is Ross stores, because they just hit their 52-week high after a massive Q4 earnings. Their stocks surged nearly 8% this week because they're providing a trade-down effect. Ross reported 9% jump in same-store sales. People who used to shop at department stores are now hunting for bargains at Ross to offset the rising cost of things. They announced a $2.5 billion buyback and a 10% dividend hike. And it's a clear sign that these retailers are basically moving towards a better option for buyers right now. And then there's Bath and Body Works, which they've been surprisingly a little more active than before, seeing their stock uptick this last week because people can't afford these luxury items right now. So they're treating themselves to little more low-cost luxury scented items, which is called the lipstick effect, which is when people start buying smaller, a little more expensive things rather than buying big ticket items when things are going down. This week also marked the 30th anniversary for Pokémon, and it's pretty hard to believe that it's been 3 decades since Red and Green launched on the original Game Boy back in 1996. Nintendo and the Pokémon Company just went all out on Pokémon Day. They officially teased the 10th generation of games, launched a massive 30-year anniversary all-out event in Pokemon Go. Pokemon is the highest grossing media franchise in history, an estimated over $100 billion in total revenue. That's more than Mickey Mouse, Star Wars, or Marvel. And between the trading card game, collectors diving up in the second market, and the launch of their new games on Switch 2 is basically showing that they're not slowing down. And whether you're a fan or not, it's pretty crazy that they have a multi-generational grip on your wallet. Moving back to the stock market, I saw a crazy news report about the Vanishing Public Company because it feels like every company you hear nowadays is private, so you aren't able to invest or do anything in them. We're living through a massive structural shift on how businesses are being built. Back in 1996, there were over 8,000 publicly traded companies in the US. Now today, that number is nearly half at 4,300. And the big things that really impacted this number is the mergers and acquisitions monsters. Basically, giant companies gulping up smaller ones before they even have a chance to make it public. The red tape, regulatory costs like Sarbanes-Oxley make it very hard for companies to want to even go public just because of the massive overhead it costs. Then there's the private money waterfall. This is basically venture capital and private equity funding all these startups like OpenAI or SpaceX, basically so they don't have to raise money on the public market. And by the time these companies actually IPO, the massive gains that were predicted to even happen had already happened in the background scenes for these Silicon Valley elites. And the retail investors just basically left with leftovers or even worse. So Robinhood did something about it. On Friday, March 6th, Robinhood officially launched their flagship Robinhood Ventures Fund 1, trading under RVI on the New York Stock Exchange. This is a $658 million close-ended fund. If you haven't basically heard of that term, it basically means it's a way you buy into private equity through regular brokerage account, just like you buy shares of Apple or Tesla. And they aren't just going for smaller startups. Their portfolio is encompassing of Databricks, which is an AI giant valued at $134 billion, Revolt, which is a fintech powerhouse, Ramp, which is a corporate platform, and even Stripe is on the roadmap. Robinhood's CFO said there's a big gap where retail customers can't access these assets. RVI is designed to fill this gap. Instead of needing to be an accredited investor with millions in the bank, you can now get a piece of these small tech unicorns for a fraction of the price. The RVI fund launched at $25 a share and actually saw immediate volatility, dropping about 3% on the first day. Private markets are inherently less liquid and harder to evaluate than public ones. Plus, they carry a 2% management fee, and which drops to 1% over the following months. However, this is still a good idea. If the numbers of public companies keep shrinking, the only way to build real wealth is to own or stay in these private companies. Robinhood is betting that their users would rather pay the 2% fee to own a piece of Databricks rather than having 0% of anything before it even IPO'd. And this comes at a good time as the economy isn't looking so hot in the job market. The Department of Labor dropped some crazy statistics about the labor market. Economists were looking at a rebound about 55,000 to 60,000 new jobs. Instead, the US market pulled and basically went the other direction and lost 92,000 jobs in February alone. The unemployment rate now blipped to 4.4%, and with the revisions of December and January wiping out another 69,000 jobs, where are we heading basically? Healthcare took a massive hit, losing 28,000 positions, largely due to the nursing strike in California and Hawaii. Manufacturing jobs fell for the 14th month. Leisure and hospitality, which are the service economy, shed nearly 30,000 jobs. Analysts are calling a no hire, no fire market. Companies are terrified of hiring new staff because of the escalating conflict in Iran and unpredictable tariff situation, because they're also trying to hold on to veterans that they've already had and trained. So they're at a stagnant position waiting to see what happens. We're also seeing an airline crisis. This week, jet fuel prices basically went vertical because of the military invasion in Iran and the disruption of the Strait of Hormuz, where 20% of the world's oil flows. Spot price for jet fuel on the Gulf Coast hit $4.12 per gallon this week. That's the highest they've ever seen in 4 years. In some regions, the price have basically doubled from its lows in 2024. United Airlines CEO issued a chilling warning on Friday. If these levels hold, airfares are going to get expensive very quickly. Most US carriers stopped hedging years ago and now are fully exposed. To put this in perspective, for an airline like Delta, every 1 cent increase in fuel costs costs them $40 million a year. And since we're not talking about cents, we're talking about dollars now. Expect your tickets to significantly increase if these fuel prices continue to rise or even stay at this level. Moving on from that, we're going to look at a company that most people know and don't realize that it basically fell off. In 2014, GoPro was the king of the world, trading at $94 a share. Today, they're basically a penny stock, trading under $1. They had a 99% decline over the last decade because of the action camera market they built was slowly being withered away because of smartphones. Now, GoPro is turning into an AI data company. They announced a new AI training program. They have over 450 petabytes of high quality real world video sitting in their cloud storage. Now they're asking users to opt in and contribute their footage to help train their third party AI video models. And the incentive is pretty there, I guess. They're doing a 50-50 revenue split. If GoPro licenses your mountain bike footage to a company like OpenAI or Google to help their AI model basically learn from what's going on, you basically get half of the money they're expected to receive, which I don't think will be much because of the amount of footage they will be basically contributing, since they've already surpassed 300,000 hours of video. And it's a pretty wild pivot from hardware to selling the experiences that was captured on that hardware. While this is basically giving them more life, Wall Street is still skeptical. And while GoPro's basically fighting for survival, SoftBank is looking for something else. This week, reports surfaced that SoftBank is seeking a massive $40 billion loan, the largest amount in the company's history. And they need this to basically double down on OpenAI. SoftBank is already a big player in the AI space, but they're looking to get an 11 to 15% stake in OpenAI's empire. So to fund this, they're starting to liquidate their old winners. And their CEO was famous for this, as they sold off their entire Nvidia stake and chunks of their T-Mobile to pile on to new winners. And this isn't new to them. SoftBank is a high leverage, high conviction, and high risk company. And to reflect this, S&P actually lowered SoftBank's credit outlook because they're worried about their liquidity. Essentially, SoftBank's entire future is now tethered to OpenAI, and it hopefully outperforms its rival. Because if OpenAI becomes the OS of the future, SoftBank would have made the smartest move in its history. However, if it's a bubble, that $40 billion loan has nowhere else to recoup from. So we'll see how this goes. Thank you for listening. I know this is kind of rushed, but thank you.